Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Low fees, passive management, diversification, low risk. Index funds offer you all of this, and with the AMCs or more the newly licensed AMCs filing for index funds, should you as an investor look towards this category, or is it just a trend that one should not be swayed away with? Let's decode all of this. I have Suresh Shatagoppan, founder, Ladder 7 Financial Advisories with me. Suresh, good evening and welcome to the Money Show. All right, so a lot of index funds being launched, and mainly we were seeing investors replacing it with the active large cap funds. But then the overall advantage of having an index fund in your portfolio, placing it right, I think this has been discussed a lot of time. Now, the question in concern, or the question that's very trendy these days, is should you be buying an index fund with a new AMC that has just got a license, or maybe the existing ones?
See, I mean, an index fund is an index fund. Okay. So
Right.
if you are going to actually, for example, launch an Nifty 50 fund, whether it is a newly launched fund house like Navi or Grow or any of those fund houses, or if it is an existing fund, if you ask me, there is not much of a difference. While saying that, yeah, there are things which you need to contend with. The experience in terms of managing an index fund has to be, I mean, has to be also given some credit and credence. However, as far as the performance is concerned, I mean, the only thing that you need to consider is you have to find out what is the kind of tracking error that is there. And as far as the tracking error is concerned, if somebody has a track record, it is better. So to that extent, if some fund house has a 3-year, 5-year track record, it is good to know that the tracking error is actually low, and the tracking error can happen, like we know, because of cash holding, because of expense ratio, because there could be a lag in terms of adjusting the underlying components of the index when it changes and things like that. So it can happen. So largely speaking, I would say I would not really, I mean, I would not really not invest in a new fund. But at the same time, knowing something about the tracking error and the kind of performance they have been able to deliver, which is very close to the index performance, is actually good to know.
And also one thing, because we're talking about passive investment and here we are focusing on the index-based strategy, can we have a sectoral approach index fund also in the portfolio, or that's something that you should really rely on the active way and the fund manager's expertise?
I would say probably if you are looking at an overall index like Nifty 50 or a Nifty 100 or Nifty 500, these kind of things, I think I mean, tracking the index will be a great idea. But if you really want, let us say, a IT index, I would probably not go for an IT index. I mean, there are two kinds of people who are going to be there. There are going to be people who are looking at certain good counters in IT, for example. I'm just giving it that as an example. And they may want to allow the fund manager to pick up the appropriate stocks and put together a portfolio for them. So an active fund will be better. For other people who really are taken in by a particular sector, they feel that particular sector will do very well. It may be IT, pharma, banking, it can be any sector. So they want to put money, but they want to diversify their investment. If that is their motive with which they are looking at a particular sector, then they can actually look at an index fund. So slightly different motives and slightly different choices of funds.
What is the low cost benefit that we talk about usually when it comes to index based funds or passive strategies?
So in the case of any passive strategy, what happens is the fund manager and the team, they need not have to do too much work on which equity to pick out. Whereas they just have to focus on, I mean, picking out picking out and having the same underlying equity in the same proportion as it is in the index. So basically, they will need to mimic the index without any lag. So because of that, the fund manager, I mean, component in terms of managing a index fund actually comes down. The fund manager risk actually really comes down. So if you look at it from that point of view, then the fund manager, whatever expense ratio they normally take from the fund management point of view, dramatically comes down, and it is true across most of the index funds. So if you really are looking at participating in a particular index, which may be Nifty 50 or Nifty 100 or Nifty 500, it may be a very good idea to go for an index fund as compared to, let us say, an actively managed fund. And especially if you are looking at the large cap oriented funds, if you look at the SPIVA report, I mean the S&P active versus index, at least in the large cap category, there is a very clear case of going for the index, because more than 65% of the funds have not been able to outperform the index. So that is the story. As far as the mid and small cap is concerned, I think there is still a lot of stock picking expertise which can help investors. So large cap, I would say index funds definitely are going to outperform, and mid and small cap active funds may be a good choice.
All right, so that's the passive strategy one can have in their portfolio. But then it's also important to balance it out in a right way, right, in your portfolio, because even though you have maybe a large cap index fund in your portfolio, but then you also have a flexi cap, and you know, a lot of flexi cap we know are having are large cap biased. How do you balance this out actually? How do you ensure that you are not over diversified in one particular market cap?
Financial advisor, normally what we do is we do an asset allocation within the overall asset categories like equity, debt, gold, real estate, and others. Within equity, typically we would say we will choose so much of large cap, so much of mid cap, so much of small cap, and so on and so forth. So in our case, we can actually hope to choose one large cap fund, which may be a passive fund, maybe one mid cap fund, one small cap fund, which may be active funds. So that kind of a thing can be done. But if I really do not want to do that, and I want to go the multi-cap or flexi-cap way, where I allow the fund managers to do that job, see, that is another kind of strategy, and I would not say it's a bad strategy. The only thing is, if I'm actually taking care of the fund's portfolio, and I'm actively managing that by way of the various mutual funds or other components, I can very well do that by simply going for the that label, that is large cap or a mid cap or a small cap, and I can actually put together the appropriate mix and I can manage that. But for people who are not able to do that, then they can go for flexi cap or multi cap and things like that. Yes, you are absolutely right. There is a limitation there. You don't know how much of small cap may be there, or how much of mid cap may be there in a flexi cap. It is going to be the fund manager's choice. You don't have too much say in that thing. So with that limitation, I think still it is a good bet for a lot of people who want to invest in equity and participate in mid cap and small cap, because a lot of people are very afraid of mid and small caps also. Performance is good and a lot of people want to do that, but yeah, I mean, it's a scary space.
All right, I think a lot of aspects that we've covered as far as investing in index funds are concerned. Thank you so much, Suresh, for taking time out and advising our investors taking the right step ahead. Thank you.
Thank you, Kavita.
All right, on that note, let's take a quick break, but then post that, we'll be joined by Gautam Kalia, who will be answering your mutual fund portfolio related queries. And if in case you want to ask a question or you want help from our experts to plan your financial goals, you can send us your queries on our WhatsApp number, which is flashed on your screen, and also an email ID where we keep waiting for your questions. Send us your latest investments, maybe mutual fund, insurance, whatever you have, if at all you want any typical financial goal related solution from our experts. The WhatsApp number is 8657974571 and the email ID is themoneyshow@etnow.tv. More on this after this break.